Hey everyone, welcome. Good to see you. I sent out that link a little late, so we may be seeing people join a little later than usual. I just got off a webinar, so I literally just got off the webinar, hopped in over here. So let's take a look at see who's in there. Hey Tim, hey Barry, and we'll take a look at how we did this week, or how the markets did this week, not necessarily how we did this week. Let's give me a moment to reset my display. I'll just reload. That'll probably be easier. There we go. Okay, so I always like to see how Gamma did for us. Let's take a look at today. So this morning, I shared with you guys that Gamma, no, I'm in the wrong group. Where is it? Okay, we gave you SPX and SPY, told you guys that, hey, there's a lot of exposure at 635, 636. That stayed pretty much all day. Where did we end? I was in a webinar, so I didn't get to see 634.42. Okay, so right around 635. So that gamma level was good, but we were floating around 634, 635 all day long. You can see this just chop back and forth in between 635, 636. I guess towards the end of the market, yeah, last minute is when we saw that sell-off down to 634.44. So today's gamma levels were pretty good. I also gave SPX. So someone asked me to start giving SPX. It was less good. We mostly saw concentration at 63.85. We didn't quite get up there. And then, of course, that sell-off took us further away from it. So sometimes SPX is more reliable, sometimes SPY. It's a little bit of an art to just kind of get a feel for if today I should be focused on SPY or SPX. In the past, I've just done that for you. Just say, okay, well, today I'm looking at SPY, and then today I'm looking at SPX. But since people asked for both, I started giving both, or at least today I gave both. I probably will continue to do that going forward. So all week long, we did see very good gamma levels. 633 yesterday. Okay, and we did end at about until the very last, again, these last 1 minute bar spikes, all week long we've been getting these. So gamma has been all good all the way up to that 1 minute mark. So like right here, 1 minute, huge volume, spike downwards, last minute, huge volume, spike upwards. We saw that multiple times, say last minute, spike downwards. It is not normal, although if we were going to see it, it would be in the last minute. Generally, sometimes it's like last 10 minutes. But in the last week, the last 1 minute, like very, very last second, you see that on Monday also? No, actually not on Monday. But that's kind of interesting to note. So that is like a mini sign of volatility, right? And a sign that institutions are trying to play some sort of game right here. There's like very, very last second, you get that little head fake in an opposite direction. But for the most part, it's inside of a choppy market. So so far it hasn't signaled anything. It hasn't really given us any information to work with in terms of a direction. Good morning, Illinois grain farmer, and a Key Hawk fan. Already made 10% on XBI. Look at you. No, awesome. Great job. That's awesome. Right, so our gamma levels, they're still working. They're working quite well this week. It's just those last minute, 1 minute bars. So maybe not up to the very last minute. Maybe if you're trading something, if you want to close it out just before the market closes, that's probably good for the time being. Otherwise, those last minute spikes could send you maybe beyond a threshold that you weren't counting on. Okay, so let's take a look at our volatility environment. So another thing that I shared on my Telegram channel is this volatility fix is getting really, really interesting here. And it really is looking like it's going to set up for a large move right here. We saw that VIX come down and actually poke its head below 15. The low was 14.95 today, and that's pretty unusual. So that would, if it stayed there, it would be a shift into a different volatility regime. We saw that it came down here, it didn't stay here, it just stayed there for a couple days and then went back up, as opposed to this where it stayed there for quite some time. So it's interesting to see that. Oh, so what that makes me want to do is I want to see what happened right here. Okay, because if that happens again, I want to know, I want to have a little heads up on what could happen over here. So let's see what happened on November 25th, December 2nd, December 9th, and December 16th. Okay, so that's during the holiday season. So that's why there's all those gaps right there. So November 5th and the next few days beyond that. November 5th. No, what? That doesn't make sense. 25th, I think. November 25th. There we go. I should just stack them on top of each other. You know what? Maybe that would be easier. Let's go to a clean chart. And I'll stack two on top of each other. We will sync them. Okay, and we'll put VIX on one. And then we'll go to November. There we go, right here. Okay, you see, so we dip below on November 25th. Let me see, let me draw my line here. 15. Okay, so we're looking, yeah, right here. We dip below. I guess I must have been on a weekly chart before, because this is daily. This is giving me a lot more bars. So we dip below here, and then, so we got complacent. We were moving up, then we went sideways, and then we had a big correction downwards. Okay. Well, I don't know how, maybe I shouldn't call it correction, but we had a big bar right here. That was 3% in a single bar, and then eventually went as low as almost 5%. Okay, so that fits into this 3 to 5% pullback that I've been talking about for 2-3 weeks now. And so we just want to be aware, if we start dipping below that 15, it's not necessarily great news. Low volatility, it just means that the market may just flatten out, and then if it flattens out, it could leg higher, but it might also leg down lower. We just want to be hyper aware of that and just be very careful right now. So if that happens, I showed you guys my Maverick indicator yesterday, and it's just showing more of it, even more so, because we have a couple 3 bars increasing upwards, and these are getting bigger, but that VIX came down. I guess technically it went tiny bit up, 0.13%. So basically a flat VIX, but we see this expansion right here. And that is an indicator, not a guarantee, but an indicator that we could have a large move or a sustained move soon. We're not really going to expect a large or sustained move to the downside, because how much lower can VIX go? Okay, so it's most likely going to be to the upside. So I am being very cautious right now inside the markets. We do look like, everything I shared with you guys yesterday, it just looks like we could be getting that pullback sometime next week. So that means if you initiate a position right now, you're putting yourself at heightened risk, and it may not show up on your price chart, on your candlesticks and your moving averages and whatnot, but a deeper layer of the market is showing us that, hey, there's heightened risk right here. If you want to go in on an opportunity, you better have a really good reward because the risk is not usual. So you want an abnormal return in that case. And if that's the case, then you're probably not looking at your normal trend following methodologies because those aren't going to have huge returns unless you're holding on to them for lengthy periods of time. If you're holding on to them for lengthy periods of time, you're really exposing yourself to that potential drawback. So trend following is not exactly what I want to do right now. I might want to do a pullback system, but it's got to pull back in order for me to enter on a pullback system. So if you're any of my directional services, don't be surprised if I'm hesitant to put on new positions. Why? I can't go short right now because we're not in that environment. We're all-time highs. It's not the time to go short. And I can't go long because we're extended by over. It's going to be very hard to find opportunities where it's actually okay to go long right now. So the non-directional systems are okay. They're just fine. They'll do very well in this environment. But the directional systems, we got to be patient. We just got to wait for our opportunities. I tried looking yesterday and I showed you guys basically every single sector, even the ones that looked really strong relative to the markets and the ones that are getting money moving into them. We need pullbacks in those. They're still not good opportunities to get in on those. 50% profit on XSP today. Excellent. Excellent. Do I offer classes on how to trade? I don't offer classes per se. I do have programs where I provide trade alerts. And I do also have a recorded now. I did it live, but it was recorded, a boot camp on trading for income and trading verticals. So those are available through the tradingpub.com. But I'm not specifically teaching trading. Within my programs, I offer a lot of education and you will learn how to trade, but I'm not specifically training traders. Maybe I should. If you guys are interested, let me know and I'll put something together with the publisher and maybe I'll do some more workshops where I can train you guys to trade. But so far, alerts, and within those alerts, I teach you the system and I teach you how to trade the system. I give you general trading rules and trading skills, but specifically to train you as a trader, I don't have that other than the income bootcamp, wealth builder bootcamp it's called. Appreciate the in-depth explanation. Oh, yeah, you're welcome. Thank you, James. Hi, John. So is it bad time to pick up options that expire 4 to 6 weeks out at this time? If you're talking about single options, then what you're counting on, if it's expiring 4 to 6 weeks out, what you need is a reasonably quick movement upwards. Okay, so let me, you guys will learn a little bit of trading. Let me show you what we're talking about. So let's find something. Pick something that you think you would want to trade directionally, either up or down right now. And pick any tickers that you guys like. Yeah, my email is kane@investpub.com. Happy to answer any questions there. Does anyone have a suggestion on something that they'd like going long or short, something that they would want to buy a 4 to 6 week option on? Apple, Meta. Okay, we'll take a look at those. Apple, AAPL. I always type that in wrong for some reason. Apple, tough. There's earnings basically tomorrow or tonight. Okay, so let's check out Meta. Same thing. All right, let's pretend they don't have earnings. Okay. So what I taught you guys so far, if anything, that you've picked up so far, probably the thing that I've repeated myself the most on was that in a pullback environment, in a low VIX environment, your best opportunities are trend following or pullback systems. And my favorite pullback consists of following a long-term trend and watching to see when a short-term trend reverses direction to match that long-term trend. Okay, I'm sure you guys are sick of hearing me say that. So that is your highest probability in that type of environment. Okay, so in the low VIX environment, or relatively low VIX environment, let's call it really 15 and below, but really 20 and below, right? It's a good environment for this. And we would go, you see that I'm going to use the EMA 8 as my short term. Okay, and then EMA 8, that's the purple line, not the line I'm drawing, the purple squiggly line. I'm just following that purple squiggly line. Okay. Okay, so in that case, when did the purple, so this red line is going up, obviously. So when did the purple line switch from going down to matching the red line and going up again? It happened right here. It happened on May 4th or 5th. Sorry about that. Well, someone in my office should be getting that. So it was, we'll call it May 5th. So if you entered on May 5th, then you would have caught that gap up and then just rode this higher. Okay, so that's your highest probability. What we're seeing right now is a pullback to the EMA 8. And that is acceptable also, because I could say, I could do the exact same strategy that I just said. And I said, I'm going to use my EMA 8 as my long term, and I'm just going to use price as my short term. If you're doing this, then you're going to be in this trade for a very short period of time. 1, 2, 3 days, most likely, is the length of your trade. Okay. So that already tells me that a 4 to 6 week option is probably too much time for this, if I'm looking at meta. And I also wouldn't enter right away. I need to see this thing curve upwards, okay? If I enter right now, I'm anticipating that it will curve upwards. Right now, all I see is that, all I see is this so far. So I don't know that it's going to now revert to the same direction as the longer term trend. It could just do this, right? It could just do that, or it could flatten, go sideways like that for a while, right? So I do need to see confirmation that it is actually going to bounce upwards. So I need a confirmation bar. So tomorrow, I would need to see a nice green bar where the high is above the high of today's bar. That would give me confirmation that the short term actually did reverse and match the longer term. Again, we're just, please pretend we're not talking about the day before earnings. Okay? So if the shorter term I use for my moving averages or my trends, then the shorter time period I'm in the trade for. Okay, so you notice how if I had used the 50-day and then I used the 8-day as my short-term trend, okay, then I enter on the 5th. Okay, I'm in it for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. I'm still in the trade. I don't, there's no reason for me to exit this trade until that short-term trend gets broken, like price crosses through it, okay? Or there's all sorts of ways for your exit criteria, but I'm already over 2 weeks into this trade. So in that case, if I had gone on this day right here, gotten in on this day right, then I might have chosen a 4 to 6 week option. But for a super short-term trade like this, I'm not going to choose a 4 to 6 week expiration. So let's wind back time. Oh, I can't do that because I won't have the option table. Okay, so let's just accept right now that I'm not going to buy a 4 to 6 week option right now. Number one, the opportunity isn't appropriate for a 4 to 6 week option. Number two, I don't want to be in a trade for a really long time right now anyways, because of all the things that we see about the possibility of a pullback. Because the broad market, if the SPY comes down, chances are Meta is going to follow. And so chances are it's going to break instead of bounce, it's going to break. Or even if it did bounce 1 or 2 days later, it's just going to break. Okay, so we always want to have that broad market context in mind. So this is not a time for me to hang on to things for several weeks. This is a time for me to take my profits and run. Okay, so now one thing that I will sort of backtrack on what I said a little bit earlier is that if I'm only going to hold on to this for 1 or 2 days, I don't want to buy 4 to 6 weeks of time. So you can always buy more time than you need. Okay, you never want to buy less time than you need, but buying more time than you need is okay. It's not ideal, but it doesn't really hurt you. What it does is it forces you to cough up more capital than you need. Okay? So you lock up more of your cash than you should have been required to. So I'll show you what I mean by that. So if I go on Meta and I'm thinking I want to buy a 4 to 6 week call, so I'm looking at about 1 to 1.5 months right here. So we're talking about anywhere from maybe August 22nd up to September 5th. Okay, so if I go over here and let's just pretend, okay? I'm not going to go into the exact options criteria right now, but let's just say to make it easy, I'm just going to go at the money, okay? So if I do this, then I'm paying, just call it $32 for that at the money option. Now, if I know that my plan, not that I know, but my plan, remember we always have a trading plan. That trading plan always includes my planned time period of holding. So I'm expecting that maybe I'm going to be in this for 3-4 days. So all I really need is maybe 2 to 3 weeks of time, not 4 to 6 weeks of time. I do want to buy more time than what I'm expecting to hold the trade, especially if I'm going at the money. If I'm going deep in the money, then I can buy only exactly as much time as I think I need. I can do that. But if I'm going at the money or anywhere from like 70 delta out to and beyond, 60 something delta and beyond, then I definitely want to buy additional time. So how much additional time is relative to the hold period? So I would say maybe 2 to 4 times as much of however long I plan on holding it. So if I have 3 days, I'm gonna buy anywhere from 6 to 12 days of time. Okay, so 6 to 12 days of time would take me out to, that would only be 1 week. So I'm probably going to be more likely to choose actually the August 8th. So if I just go at the money August 8th versus at the money September 5th, then I only need to invest $24 here, $24.50. So over here, I lock up an additional $600-700 of capital unnecessarily. Okay, and it's also going to affect my returns. Because of that, my return over here is not going to be nearly as good. So let's just say I'm right about this popping up. Where am I going to exit? What is a reasonable, there's a lot of ways that we could choose to determine this. We could say, hey, maybe I exit at that high because I'm expecting some resistance right here. Or maybe I can say, hey, I'm going to exit 1.5 ATR from my entry point or from my bouncing point. Why? Because it's a good practice to look at you want to be right in a non-random way, and you want to be wrong in a non-random way. So if I'm wrong, I want to be wrong because this broke and it went down, not because I just got stopped out just because it swung down temporarily. Okay, so I want to give myself one ATR of room on the downside, which means I need to give myself at least one ATR of room on the upside in order to preserve at least a 1-to-1 reward risk ratio. So if I do that, if let's just say the current ATR is 42, this is a high price stock. Okay, so if I go 42 up from right now, that would be, what is that? 42 plus 15, so that's 760 minus 3, 757. Okay, so that would be up here. That would be just above the high right here. And if I go another half ATR above that, that'd be 777. So just call that 775. Okay, we'll just call that 775. Let's say I'm right. And it actually hits 775 in 3 days. Is that unreasonable? Is that an unreasonable expectation? 1, 2, 3 days. Is that unreasonable? Doesn't look all that unreasonable because the price has already done. That's not unreasonable at all. The slope over here is pretty much the same as that slope right there. So there's no reason for us to say, oh, that's impossible. That's pie in the sky. I would have to go parabolic. No. All it has to do is match the rate that it's been going up over here. And we could hit that target in 3 days' time. So if I'm right about it hitting in 3 days, 3 trade days, okay, so 3 trade days, 1, 2, 3, Tuesday, and we hit 775, that's 60. Okay, then this 4 to 6 months out, it will theoretically be worth $69. Okay, so just say we got in at 32.5 and then went to 69. That's pretty good. Okay. Okay, that is a 112% gain. That'd be a nice win. Okay. But what about that August 8th? Okay, the August 8th is theoretically $62, okay, on my 24.5. Okay, that's 153%. So that's a pretty big difference in performance, okay? Now, you could say, okay, well, what about the other side? What if we're wrong? Okay, what if we're wrong? So if I'm wrong in 3 days, I shouldn't have deleted all those things. There we go. So if I'm wrong in 3 days and we don't go to up here, and just say we stop ourselves out at, I said 1 ATR, but you probably don't want to risk 1 ATR. You're probably pretty clear that you're wrong if before you hit that 1 ATR mark. So let's just say we go below the EMA 8, okay? So if we go below the EMA 8, then that would be roughly, so say we close at these lows right here. It's always good to look at price history and pick your levels based on actual prices, where prices actually were. Obviously, we reacted to this price a few times in the past couple weeks. So what if we go down to 682, let's call it 682 in 3 days. It's 682 would be 30, so about 28. Did the 33. Okay, so let's just say 682.56, okay? So then this one theoretically becomes $7.30, ouch, right? Okay, -1. Okay, so we lost 70% right here. And then for the other one, theoretically it becomes 1590. So on the downside, you'll have the extra time will give you an advantage. But if I go 1590 divided by, what was it, 32.5. Okay, here I lose, oops, what did I do wrong there? 15.9 divided by 32.5 minus 1. So here I lose 51%. Okay, so, but now we need to compare. We want our reward risk ratio. Okay, so if I have 100 and, I think it was 12% divided by 0.51. Okay, I have a 2.2-ish reward to risk ratio versus 150 something percent. Was it 151, 152% divided by 0.7. Okay, 2 points. So they actually end up with very similar reward risk ratios. So in this case, we'd be indifferent. It'd be kind of their performance and their reward risk ratio is the same. However, one cost me a lot more money to get into. Okay, it required more capital to be put up, and actually it's more capital at risk, right? So if I suffer this loss, even though it's at a 50, so that'd be $16, a little over $16, and here this would be what is this? About the same. About the same. Okay, ends up being about the same. So it's just how much capital up front do you want to lock up? So sometimes the math works out very differently, and you'll see that the shorter term one would have acted much more favorably. But in this case, they were pretty much the same. So the only consideration is how much money you're putting up. Okay, but it's always okay to buy more time than you need. It's if you buy less time than you need, then you expose yourself to all sorts of crazy risk. Okay. Did I answer your question or did I go on a tangent? I think your question was, is it now appropriate to go out 4 to 6 weeks on expiration on a directional trade? My answer to that was no, because we are anticipating a pullback potentially in the next week or so. So in the current environment, you want very short-term trades. You don't want to be holding positions for 2 or 3 weeks. You want to hold positions for 1 or 2 days, maybe 3 days. You want to profit and run, okay? And so in that case, I wouldn't be buying a whole bunch of time. Okay. Would the breakout be 15 to 30 minutes of the opening bell? Which breakout are we talking about, Tim? Were we talking about Meta? I'm sorry, I didn't see your question until too late. Omar is giving me some suggestions on ticker symbols. Would I mind sharing my TradingView code for ATR on a screen? That's so much nicer than having. I don't mind, except TradingView hates me. They think all my indicators are useless. And they think that they don't add anything to their community. Okay, so I can show you, I've tried many times to share my things, and they ban me. I can only do invite only scripts. So that's the white ones are all invite only scripts. Anything I try to make public, they ban me. So and their comments are always like, yeah, they're just not that useful. They don't contribute to the community. There's not anything new about them. There's nothing, okay, but I find them useful. So, yeah, I would love to share it with you, but TradingView just doesn't let me. Okay, will not add to the ones I have. Good. So Omar, we can take a look. I mean, let's take a quick look at Ethereum. Huge run up, continuation, smaller run up. This thing, it needs to pause. It's probably, and especially since we got the red today, it's most likely going to pause and go sideways or pull back down a little bit. So I would wait for that. I would wait for Ethereum. PayPal. PayPal, are you thinking bullish or bearish on this, Omar? PayPal is, in my opinion, okay, and again, ignoring earnings. If we didn't have earnings right here, this would be a very mild bullish play that you would be very careful about managing risk on. And this is not something that I would recommend to beginners, okay? So what we see is that this huge sell-off in this giant flat and sort of like really slow, maybe U-shaped recovery. Okay, so, and then you've got that MA200 right there. We could just smack into that and come back down. So I'd be very careful with PayPal. And of course, earnings could change that. It could just shoot up. Am I on, how am I on, I'm on a weekly chart. Okay, yeah. Let's take a look at daily. Yeah, same thing, right? It just barely got above its MA200. Okay, so we got earnings in a few days. So what I want to see is, because this is not what I call a breakout. A breakout is a nice, strong bar. Let's see if I can see a breakout. This would be more like a breakout, okay? Nice, strong, large bar closing near the top, okay? This is a doji that gapped up above. Okay, this could go right back down. Okay, so I would need confirmation. So in this case, if it does go further up, that's not great either, because then the opportunity got away from me. I would wait for a pullback down to the MA200 and a bounce, then that would be a good entry. So PayPal is wait and see. Okay, and TSM. TSM is looking great, beautiful trend right there. This is a continuation mean reversion play. So pull back to the EMA 20, go up, pull back to almost to the EMA 20, bounce up, pull back almost to the EMA 20, continuing up. So TSM looks good. But again, overall markets may have a pullback. So the question is, if the overall markets pull back, does this pull back to its EMA 20, or does it break it and go back towards its MA 50? And then earlier this week, I think it was, I showed you guys how to use beta to kind of estimate that, right? So I would refer to that. And then IonQ. PayPal bullish on Omar. Okay, yeah. The latest upside is on downward volume. Are you talking about PayPal? This is on, I would call that very small, yeah, very flat volume. Yeah, not necessarily downward volume, maybe this leg over here. But over here in the last week, it's been on a very slightly increasing volume. But again, it has earnings, okay? It already broke out. It wasn't like a nice clean candle. So I would wait. I would wait to see if it comes back and tests that MA200 and then potentially go out from there. Again, a lot is going to depend on earnings though. Okay. And then IonQ. IonQ, I needed break above this level. Couple reasons why. Because if we do, I'm just going to repeat myself again. Okay, if we take a look, why didn't that continue? Path. Okay, so if we go up, down, up, this is kind of down or mostly flat, I would call it. Okay, I haven't gone up yet. Okay, so I would want it to go up, but once it goes up, it's going to smack right into that resistance again. Okay. And so that's why I need it to break out of that resistance before I'm interested in it. And then it sort of looks like, again, I don't use patterns, chart patterns, but it would look like a cup and handle. But the reason why I don't use chart patterns is because there's always something more fundamental happening inside that chart pattern. That means that basically I come to the exact same conclusion based on what I drew over here, right? It doesn't matter to me that it was a cup and handle. Like technically this should have been the handle right here, but it rejected. Right? So all I care about is that I'm reverting, short-term reverting to the longer-term trend, and I break through a resistance level. So it doesn't matter what it looks like when it does it. A lot of times it will end up looking like that cup and handle. But what if I get a cup and handle and my MA50 is actually flat? Does that work anymore? No, it doesn't. Okay, so they're missing the picture. They're missing something a lot more fundamental that actually makes the cup and handle work. The cup and handle by itself isn't meaningful. There's something else going on beneath it that is meaningful. So that's why I don't like chart patterns, because they obscure you. You're not looking at the actual phenomenon. You're looking at like an order on top of the phenomenon. You're looking at an effect of the phenomenon, not the actual phenomenon. So I'd rather look at the actual phenomenon. Okay. All right. So I think, we talked a lot about picking your expiration dates. Hopefully that was helpful to you guys. And one big major lesson per day, I think, is more than enough for a mind to absorb. So I don't want to pile on top of that. Bullish on HWM, do you think that is a good long-term stock? HWM has been doing great. It's in the defense sector, which has had a lot of money rotate into it. Look at this trend. Look at that's crazy. Since last, it's been going up for a very long time, right? Technically, you could say right here, but this is beautiful. And on a very long-term trend is actually going parabolic. On a long-term trend, I don't care too much if things go parabolic. If it's short-term, then I need to see pullbacks. But we have earnings coming up very soon. If you're already in this, no problem. Maybe hedge yourself if you're going into earnings and you bought way down here. Would I start a position right here? No, I would wait until after earnings because that could change a lot of things. But at any point in time during this time period since April would have been excellent play. Even before April we saw that dip because of Liberation Day, but anytime before that, it's been really, really good. And defense is seeing a lot of attention. So HWM is something that I would be interested in the longer term, assuming that earnings holds up. Okay. What is my opinion on trading stocks worth $20 or less instead of options on expensive stocks? If you're trading stocks $20 or less, then you are mostly playing in a field where there's a lot fewer institutional players. Okay? So then you're trading against retail guys, you're trading against prop firms, which are technically an institution, but the smaller institutions. So the game is a little bit different. And you naturally get more volatility. So you wouldn't be trading necessarily trends like this. You want to play a higher volatility game. So breakouts, quick moves, ups and downs, parabolic moves, things like that. You could start using retail trader tools. So a couple of weeks ago, someone asked me about Fibonacci. So I would never use Fibonacci. I never use Fibonacci, but I for sure would never use Fibonacci on large caps or anywhere that institutions play. But you could use it on small cap stocks. And I gave a couple of examples that actually worked out kind of well on the small cap stocks. And then I used it on SPY and it did not work out at all. Okay. So you could use retail trader tools on stocks below 20. Okay. Then you remove the headaches of having to worry about expirations and time decays and things like that. But also understand that you're not, without institutional backing, it's hard for a stock to move long term like this. Okay? So because the institutions are going to buy, then they're going to buy, then they're going to buy, they're going to buy until they're done with their buying program. And when they sell, they're going to sell and they're going to sell. So that's what creates those long trends. And you're probably not going to see at nearly as clean and pretty trends on those $20 and less stocks. Yeah. So you just have to adjust your strategies to be appropriate for those stocks. And then you may have volume issues as well. The volume may not be as strong. I miss getting the morning payout. Okay, so normally I don't talk about programs, trades, Barry, but I guess you're asking me a general question, so it's fine. But can you get in first thing tomorrow? No, never. On morning payout, you never get in the next morning because then it becomes a day trade. Okay? And a lot of the profit that you should have experienced is already realized by the morning. Generally, between 3 and 7% is already realized by the morning. So there's not enough juice to make the reward risk worthwhile for you if you try to get in on the morning. Thank you. You're a happy subscriber to the Morning Panel. Oh, thank you, Chong Trades. That's great. I'm glad that you're happy. Okay. All right. Any other questions I can answer? Otherwise, yeah, like I said, I don't want to pile too much on you guys all in one day. Okay, I'm not seeing anything. Looking good. All right, so have a wonderful rest of your day. And didn't know there were tools for retail. Okay, so almost anything you've ever heard about, anything that you can find on the internet, almost all of them are retail trader tools. You will not find a $100 million, multi-$100 million, billion-dollar firm that is going out there using Elliott waves, using Fibonacci's, using whatever. I don't even know all of them. It's like I don't even pay attention to them. They are not. They will use the MA200. They'll use the MA50, MA90, or 100, depending on the institution. Okay. Not much else. Even this, your Bollinger Bands, your whatever, your RSIs, your giant institutions are not using those things. Okay, so those are all basically retail trader tools. Okay. All right, guys. Thank you. I thought it was a great session as well. Have a great rest of your day, and I will see you all tomorrow. All right. Bye, guys.